Stagflation is an economic cycle characterized by high inflation, stagnant economic growth, and elevated unemployment, all occurring simultaneously. Here to dig into this is Keith Buchanan, who is the Senior Portfolio Manager at GLOBALT Investments. Keith, great to have you back on with us. So just break down the stagflation call for us here.
Thank you, Brad. It's quickly coming back into the lexicon of market participants and onlookers. The same. We've looked at this over time, and it's been a risk that clearly over the last 3 weeks has exploded onto the scene. And moving into this year, their worry was on the upside. That animal spirits would push the market and economy even further and quickly into more of an expansionary phase. But the tariff conversation and international trade policy really changed the dynamic. And we've seen the tariff conversation evolve over time very quickly and rapidly in a way that brings caution into the investors and business owners that have to make these investment decisions, as well as just understanding kind of where we're going over the next 12 to 24 months from a Fed policy standpoint. So we see, tariffs have to come from either one place, either puts pressure on prices or growth. Widespread tariffs can actually hold the effect of doing both at the same time. So that fear is permeating across the market space. And that's why we're seeing a lot of volatility around risk asset prices on an intraday basis.
And so with that in mind, what type of damage, what is the scale that you think widespread tariffs do to both prices and growth here as you're tracking it and could pass through to the broader economy to prove this theory true in stagflation, what we're anticipating?
Right. So we're in unprecedented territory where we don't have a playbook for an economy our size with the leadership that we have with these types of trade policy shifts. So the caveat is we don't really have a great playbook, and that also leads to the risk as well, whether or not it has impact on inflation or growth or how that pans out. But the fear that's going through the market is definitely that it has an impact perhaps on both. And that's where we're trying to parse out on a day-to-day basis. Also, depending on what we have coming out from the administration, is to understanding just the global trade impacts as well as on our GDP for business decisions and the growth prospects for our economy going forward. So those exercises is, we're definitely in uncharted waters, and everyone's trying to do their homework in real time. And that's causing a lot of concern.
And so for the reaction that we've seen in the markets, do you think this is an overreaction, or do you think that it is warranted?
Look, the markets react to uncertainty most dramatically, especially quickly onsetting uncertainty. And that's what we have on how rapidly developing this conversation is. One thing that we've noticed is it causes a different behavior from investors and business owners alike, in that when you have this much uncertainty around on prices and supply chains, the natural reaction is caution, and that leads to pockets of liquidity and decision making in the process of corporate decision making when it comes to working capital and as far as capital deployment, that just disrupts the normal flow of things. And that disruption typically causes a decline in risk assets and a wider bid-ask spread across investment decisions and business decisions as well. So that disruption and lack of liquidity and lack of certainty definitely leads to rockier markets. And again, it can offer opportunities in certain spaces. And it could be truly pricing out risks in other spaces. And the problem is we don't know until we're looking back in hindsight which was which. So that leads to a lot of uncertainty, a lot of risk in risk asset prices on an intraday basis.
All right, so where are the safest, perhaps, havens that you're looking across right now, or even just top picks for a rebound?
Sure. There's undoubted there's pressure on the consumer that we have to recognize, and I think the entire market is starting to recognize this. There are pockets where we feel like there are opportunities to participate in names that have sold off in a way that doesn't really reflect the fundamentals, and also even the go-forward case for those particular equities. Right now, Walmart is one that we like, that we look at as an inflation and slower growth hedge. As prices go up, particularly in the grocery space, that drives customers into the doors they typically won't, higher income customers that they typically haven't had on their outs, as well as when growth slows and you have higher unemployment, that also drives traffic within their stores too, as they have seemingly a price advantage on other widespread stores from the grocery to general merchandise. Also, looking at an airline like Delta, we saw last week that all the airlines have started a little more cautious stance, and those stocks have reacted in a pretty dramatic way. Our holding in Delta isn't really predicated on the next month, and they've talked about how the summer spending has kept up, international travel has kept up as well. So we want to look through this air pocket and take advantage of the lower valuation in Delta to seek those outsized gains and returns for our clients. So a name like Delta is also attractive at these levels.
Keith, great insights as always. Appreciate the time.
Thank you, Brad.